this is the near-term outlook for inflation and growth, which I think we need to really spend a lot of time and be very aware of as policymakers. And I'm going to talk about it in the context of the outlook for inflation and growth. I don't need to take you to all the data. This is just a chart which shows that thanks to the efforts of the government, the RBI, and technology and the weather and all those things, we've substantially overachieved on inflation. For the last 10 months, our analysis, our estimates are that we have done better than whatever target we set ourselves by about 150 basis points on average for almost a year, for about 10 months. And this is true for headline inflation, and we're also doing very well on core inflation as well. Now, this is what has happened. What is the outlook? We list all the factors that will determine the inflation outlook going forward. You know, the exchange rate has appreciated, which will reduce prices. The monsoon has been good, which will again reduce prices, but there are bottlenecks in fruits and vegetables, which might raise prices. The GST, I think, on balance will reduce prices. Seventh pay commission the other way, etc., etc. And a crucial determinant, domestic determinant of inflation is the output gap. Where is there slack in the economy or not? And that I'm going to come to. But if you put all of this together, our assessment is that end March inflation is going to be well within target, and average inflation for the year as a whole is going to be well below target. Even if we reach about just above 4% by end March, inflation for the year as a whole, which is the more important number, the average inflation for consumers, investors, households, that will be probably closer to the 3% mark than the 4% mark. And that's very important, you know, when we talk about what the policy responses should be. Now, similarly on growth, we know that there's been an across-the-board deceleration in real activity since the first or second quarter of last year. And I think it is quite telling that for the first time, many indicators which you see here, real credit growth, IIP manufacturing growth, investment, GVA, all point in the same direction of deceleration in growth. The question now is, what is the outlook? Now, sure, I'm going to be a boring professor for 1 minute, because when we think about India's growth outlook in a kind of big picture sense, where we are, one perspective on this is what is called the twin balance sheet perspective. Now, this is a chart that shows credit to GDP for a number of countries that experienced a credit boom, growth boom, and then a credit collapse and a growth collapse. Carmen Reinhardt and Ken Rogoff of Harvard have this famous book saying that after this credit bubbles, we have deleveraging and growth slows down for a long period of time. And then when the cleanup is over, then growth picks up again. Why I'm showing this chart is to point to where India is. And the surprising thing is that India, we've not deleveraged at all, barely deleveraged. So in terms of the Reinhardt-Rogoff perspective, the twin balance sheet perspective, you know, it is, I think, almost premature to say or to think that growth can rebound very quickly unless we do and clean up and do the deleveraging in the first place. So I think this twin balance sheet perspective, the fact that we've not deleveraged enough, is something that we have to keep in mind as we think about growth going forward. Now, I want to go through 3 or 4 of the key and new things that affect the growth outlook. Farm loan waivers, item number 1. I'm not going to say good, bad. I think the governor of the RBI made some very thoughtful remarks on what it does to credit culture and so on and so forth. I'm not going to talk about that. The essential point I want to make, an analytical new point, is that farm loan waivers are going to be deflationary, not inflationary. In this survey, we calculate what the likely magnitude can be. You know, it depends upon a lot of assumptions that you make. It could be somewhere between 1.25 lakh crores and 2.7 lakh crores, depending upon how many states implement it. And it's going to be deflationary for the following simple reason and under one critical assumption. The critical assumption is that, as the finance minister has repeated, the center will not relax the fiscal borrowing limits of the states. If that is the case, then in order to accommodate the loan waiver, states will have to either cut expenditure or raise taxes, which will be deflationary. Now, this is not something I'm making up. Look at the UP budget. Look at the UP budget. Capital expenditure has been slashed by about 13%, if I'm not mistaken, to accommodate the loan waiver. That slashing of capital expenditure represents less demand, less growth. And it's because of the way the loan waiver interacts with the FRL limits that we're going to see this deflationary impact. We calculate that the impact on demand could be somewhere between 0.3%, 0.4% and about 0.7% of GDP, which will be a drag on growth. We also estimate what the fiscal impact could be, which is about, again, similarly, depending upon which states do it, which states have limits. You should go and see the table there. I mean, there could be some impact on aggregate state deficits because remember, those that are already at the limit, they cannot expand their deficits. Those that are not at the limit can use up the space to expand their deficits, and that's why aggregate state government deficits could increase marginally as a result. But the farm loan waiver is going to be deflationary, exerting a drag on growth in the short run, is what I want you to take away. Similarly, I think that another drag on growth in the short run is the rising stress in the power and telecommunication sectors. These are just charts that show you how much of the debt is getting, exposure is getting increased, and how it shows you both the profitability of these sectors in the aggregate and what the impact on the NPAs could be eventually. The key point here is that stress is rising, and what is interesting is that in both these sectors, stress is rising because they're experiencing shocks which actually are going to have positive impacts. In telecommunication, we know that there's a new entrant which is reducing prices to consumers in the companies, and hence on demand, and hence on growth in the short run. Agriculture, again, we've seen a lot of stress. I think what people need to understand about this bout of what's been happening in the agriculture sector is that there is a puzzle going on, which is that we are seeing reduced farm revenues in the non-cereal crops despite a good monsoon. And that's the puzzle. If you look at the last 3 years, when there is a good monsoon, what has happened is output has gone up, prices have come down a little bit, but revenue has gone up. Similarly, when output has come down, revenue has come down. This is the first instance, or in recent memory, where you've had good output, good monsoon, and despite that, revenue has come down because prices have come down by a lot. And that's a bit of the puzzle. Why did prices come down so much? Is it because of some policies that restricted the access of farmers to where they could sell? Is it because of weak demand? Is it because of inadequate credit and liquidity? I think these are the questions that we need to answer going forward. But I think that it's very unusual to have both reduced farm, increased output and reduced revenues, and that's again going to impact demand in the short run. I don't want to take you through all this. I want to rush through this. The final deflationary impact, of course, is that if you look at real interest rates and the exchange rate, real interest rates have been rising. They're high. The exchange rate, the real exchange rate, has been appreciating. Competitiveness has been affected. So both from the domestic side on monetary policy and the external side via the exchange rate, we are seeing a greater drag on growth. So how do I put all this together? To cut a long story short, the summary is that the balance of risks to the growth outlook has clearly shifted to the downside. I think one upside possibility is that more exports, because the world economy is recovering. To some extent, we had factored that in already into our February outlook. Maybe that could be surpassed. But on balance, the risk to growth has shifted to the downside. Therefore, the balance of probability has correspondingly shifted away from the upper end of the growth forecast that we made in February. So we're not changing the growth forecast, just saying that because of all these risks, it's less likely that we will see outcomes towards the upper end of the forecast. Now, monetary policy, I just want to provide you a technical assessment. I think, as I said, there's been a structural decline in inflation, and that's what creates the scope for lower rates. To the extent that these are temporary, as is being argued, then there's less scope. But on balance, I think there is scope because of these factors which have outlined the outlook and the structural decline. What we do in the survey is that we calculate what the neutral nominal rate should be based on the RBI's internal studies of neutral real rates, and we say that the simple calculation yields that those neutral rates should be somewhere between 5.25% and 5 and 7.5%. But here's what I think is something new I would like to say, is that when thinking about this from a technical perspective, the Taylor rule is a very nice way of trying to understand this. Basically, there are two steps to seeing what technically should be the interest rate. One is you see what should be the neutral rate when, neutral equilibrium rate means that your inflation is close to target and the economy is close to potential. And that gives this 5.25%, 5 3/4. But what the Taylor rule says is that over and above that, you have to factor the economic cycle. If you are at a stage of the cycle where there is a lot of slack, then the actual rate should be below the neutral rate. If there is very little slack, you should be above the neutral rate. And given our assessment of where the economy is, which is, we are still below potential, capacity utilization is not as high as it should be. Therefore, technically speaking, interest rates should be below the neutral rate, so that if you then factor into where we are, it says that we have a scope for lower real interest rates. And this is the chart that shows that. A last point here, there is a lot of discussion about will it be effective, will it be ineffective. It is true that when you compare policy rate reductions with the base rate, the reductions in the base rate are not commensurate with reductions in the repo rate. But if you look at incremental lending based on MCLR, you find that, and go back to March 2014, you find that reductions in the lending rate of banks has been commensurate with reductions in the policy rate, and that's especially true for the private banks. So it is not, I think, totally accurate to say that, reductions will not be passed through. There does seem to be passed through, especially for the private banks, and these reductions will affect all borrowers, including small and medium enterprises. So the bottom line is that there is scope, there is both need, because we are at a stage of the cycle where we have a lot of slack, and also that these things will be effective. That's what the data shows in terms of how much of these rate reductions have been passed on. I think the fiscal outlook, just 2 more minutes. Fiscal outlook, I think there are some downside risks. GST, uncertainty, growth outlook, spectrum receipts, 7th pay commission. Those are the downside risks. The upside risks are there as well. Compliance benefits from the GST, expansion in base from the GST, demonetization and the new taxpayers could provide upside risk. So, we'll have to see how fiscal, the deficit and revenues and expenditures evolve over time. And at some stage, it's possible that the magnitude and pace of fiscal consolidation relative to the commitments made may need to be assessed going forward. Last point on agriculture. I think that we tend to forget that over longer horizons, there is no necessary opposition between farmer interests and consumer interests. What I want to show you in these is that in this table in the chart, especially the chart on the right, it's really amazing how how well farmers react to prices. If prices go down today, farmers plant less and supply goes down and prices go up, so that on balance, you don't really get any benefits from lower prices. So this chart shows that, lag production and the WPI very highly correlated. And if you look at the data on recent plantings, you find that pulses plantings have come down because prices last year were down as well in the last thing. Same is true for oilseeds as well. So I think this is a perspective that we need to keep in mind, that farmers respond to prices and that there's no necessary opposition in the long run between farmer and consumer interests, especially in non-tradable agricultural commodities like pulses, fruits and vegetables. I think that the challenge here is that we both need remunerative MSPs backed by effective procurement. This year there was a big increase in procurement in pulses by about 2 million tons, but there were lots of states and in commodities where not all the crop could be procured at MSP. So we need to both provide remunerative MSPs backed by effective procurement, but at the same time, we also need to ensure that prices that farmers receive are, healthy and robust, and we need to, look at policies that could actually prop up market prices, i.e. above MSPs, so that farmers can get a better realization of prices as well. And of course, as a general, a big thought I leave you with is that maybe it's also time to consider, given what's happened in the agricultural sector, whether direct support as opposed to indirect support can be more effective. So in conclusion, let me say that there are very favorable medium-term developments which I've outlined. The real challenge now is short-term growth and how we need to respond to that. And I think we need to bring to bear all the policy tools that we have to revive short-term growth. Thank you.